Okie dokie. All right. Well, hey, this is Kurt Frankenberg, the founder of RadioActiveTrading.com, and I'm joined by my good friend, Mr. Mike Chepka, over at Power Options. How's it going there, Mike?
Oh, things are going great, I guess. I guess the market may not be doing what a lot of us want it to be doing. We've seen some red in the past several days, and there's been a little bit of movement up and down, but it seems to be continuously red over the past few days, and that's been worrisome for some of us, for some of the customers I've been talking to over the past 2 weeks, 3 weeks maybe, but I know I'm doing okay.
Yeah. Yeah, you know, I got an email this morning. You may have seen my copied reply to it because you get to see the support at RadioActiveTrading.com. We had somebody write in and say, hey, if you get a stock at $30 and now it's at 20, should we buy a put now? And I said, well, you know, that's kind of like, you know, waiting for your house to burn down, and then after it's burned down, say, you know, we should probably really take a look at that insurance policy, make sure we've got one. I don't know about that. I think it's important to have your insurance policy in place first. And anyway, I told that to this gentleman, and you know, I told him, hey, I'm not trying to be a smart ass or anything, but no, the time to have bought the put was when it was at 30. Not now that it's lost 33% of its value.
Right, and if at this point, though, and you continued on with that, and at this point you're absolutely right, but, you know, it comes down to if you're going to stay in that position and you're going to try to, you know, make money back, you know you're going to be staying in it long term to try to get back to break even if you're fortunate enough, but it doesn't hurt to buy a put at that point if you're planning on staying in the position, because that way at least you save yourself from any further hemorrhaging if the stock doesn't do as you expected.
That's true. That is true. It just would have been better timing to do it at the same time. So.
Oh, I agree with you 100%, sir.
All right. We're going to be talking today about a bulletproof RPM, but we're going to also be talking about the riskless spread trade I promised in the email this morning. And I guess what I'd like to do to kick things off right now, Mike, is I'd like to just run a poll today and find out where you're coming from, what kinds of options trading you're currently doing, and then we'll get rolling. So looks like a lot of folks doing combination trades, equals and diagonals. Okay. We've got a surprising number of folks still doing the cover call strategy. You know, Mike, maybe I should do our conspiracy theory thing again sometime here soon. Talk about cover calls. Yep. Okay. Let's leave that up there for about another 10 seconds. And, folks, we're going to launch into what I think is going to be a great benefit to you. You're going to really enjoy. But we're not going to charge anything for it. And we're also going to not do any kind of a big sales pitch today. I figure most of y'all are grown-ups. You know, sometimes we do a special a special push, you know, because we got to pay the bills. You know, we've got to somehow finance doing these free webinars for you twice a week. And so sometimes we'll do a sales pitch, but I figure most of y'all are grown-ups. You know you could go over to RadioActiveTrading.com and educate yourself on what things are available. So we're just going to kind of lay off that. Okay, Mike, I'm going to go ahead and close the poll now. We got 75% of the room has already voted. And patient there, folks. Okay, so it changed. At one point, the cover calls were ahead, but now we've got 38% that are doing cover calls, 29% doing long calls and puts, and 50% doing verticals, diagonals, and condors. And then we have one fella. Well, more than one fella. We've got 4% here saying I'm not trading options at all. So, well, welcome. You know, glad to see you. We're going to be sharing some really neat concepts here today, and some of it's going to be real simple, and some of it's going to also give a real taste to folks that are more advanced, and give kind of a, I don't know, a whole new vista, a whole new way to look at You'd agree, would you, Mike? Whole new way to look at certain types of spread trades.
Absolutely.
Yeah. So very good. Okay, let me go ahead and hide that mic, and thanks to everybody for introducing yourselves. I'm going to introduce myself briefly. My name is Kurt Frankenberg. I teach martial arts. That's what I've been doing for the last over 30 years now, and 26 of it on my own as a independent martial arts studio owner. And somewhere along the way, I got successful enough at that I was making a lot of extra money on the side, and thought, geez, what am I going to do with this? And so I got into real estate investing, which I quickly found out I just wasn't cut out for. Some folks are into it, but it just wasn't my gig. It wasn't my game. And so I turned from that. There was a fellow that was very respected in the real estate investing arena, and he had begun to teach about stock market investing.
Mm-hmm.
And I went to his seminar, and it cost $3,500 a seat. He came out there in a $1,500 suit, and taught all about trading covered calls and trading credit spreads and calendar spreads. And I thought, wow, this is amazing. This is so cool. And I followed directions to the letter, and I ended up completely broke.
Mm-hmm.
So that's a little bit about my story. Now, being a martial arts instructor, being the kind of guy that I actually coach cage fighters, in the cage. Well, I don't get in the cage at that moment, but but between rounds, then I run inside and coach. And if somebody's losing, somebody's getting beat up and so forth, and it's something that they can correct, I'll throw in the towel if it's not something they can correct. Okay, but if I'm on the outside looking in and I can tell, you know what, if he just kept his hands up,
Mm-hmm.
or if he just did this or just did that, that's my function. I run inside there and I'm a coach, and I say, look, you need to change your behavior. You need to do something a little different. And after losing all my cash doing the covered calls method the way that I had been taught, I thought, well, there's something wrong with my behavior, and decided to change it. And Mike, now that one thought about keeping your hands up, when you get into the cage.
Mm-hmm.
Because the market is just as full contact as it gets, without putting on gloves. Some folks might even argue it's like fighting with your gloves off. But that one change has made all the difference in not just my trading life, but the trading lives of thousands of people, including yourself. And I'm really grateful for that. So that's me. Mike, you want to introduce yourself and Power Options, the company?
Mm-hmm. Yes. What I wanted to say is that unfortunately, Kurt's story is not, from my experience over the past 10 years. I guess I'll start that way. I'm sorry. My name is Mike. I'm the Director of Education here at Power Options. Power Options, of course, is a patented suite of search and analysis tools designed for self-directed options investors, and we support over 23 different strategies. We've been in business for over 15 years. And over the last 10 years or so, I've been with the company, 9 years going on 10 years. I probably talked to about 15 to 20 different customers per day by phone, and then an additional 5 to 10 customers by email, or sometimes more or less. And unfortunately, Kurt's story that he told you is not, it's more common than you think. A lot of investors have done that where they've paid $2,000, $3,000, maybe even $15,000 to learn how to trade options, and then in a short term or a year or so later, they find out that they're behind or their account is down significantly and they're just not getting ahead. Now, I met Kurt 4 years ago, over 4.5 years ago actually. He was a customer of Power Options, and we were on a coaching session. We were discussing his technique and how he could identify positions. And when I first saw his initial setup, I said, well, I appreciate that you're limiting risk, but I have a feeling you're paying too much for the put option. I don't see how you're going to make any money with this strategy. And at that point, Kurt invited me to join him for one of his free webinars, just as you all are doing right now. And he said, let me show you how I make money with these strategies. Well, I was so impressed with the techniques that I invited Ernie Zarrenner, the president and founder of Power Options, to join us for the next couple of presentations. And Ernie, of course, was so appreciative and blown away by the approach and the technique that we decided to partner up with Kurt. enhance our tools on power options, both in the main search and in the portfolio tools, so that radioactive traders had a platform to implement this technique with ease, for lack of a better term.
Right. Well, and it's been a real ride since then, hasn't it, Mike? You've had the opportunity to, first of all, save yourself during the 2008 crash.
Mm-hmm. Yeah, at any given point now, Kurt, as we've talked before, is since those last 4 years, in the last 4 years or so, my trading account has been made up of 50 to 60% of my invested capital at any time is involved in a radioactive trade, or radioactive trades, I should say. Another 20 to 30% of my investing capital is in standard collars. Then maybe 5 to 10% of my capital is invested in small credit spreads or iron condors on the broad-based ETFs or indexes.
Right. So that's kind of exciting.
I think so. Yeah.
It's really exciting to me. Well, Mike, let's talk here about what folks can expect today, and then let's just lay it on them. Okay. First of all, here's what to not expect. Don't expect a big sales pitch. Okay. We're not going to be talking about this offer that's so limited, and you better pick it up right now, or you face losing out and yada yada. We're going to give a no BS and true educational seminar. Okay, it's going to be truly educational rather than a disguised sales pitch. Okay, so 100% content guarantee. Put your wallet away. We're going to take a common problem for traders. Okay, we're going to fix it, and then I may point you out to further free resources. All right, that's the extent of the sales I'll do today, is to just point you out to something further. It's not even my product, but something that you might look into for a free trial. Okay, so that's what to expect from today's RadioActiveTrading.com webinar, and let's get started here. Now, we already asked this question. Okay, what kind of option plays are you doing right now? I'd like to ask a follow-on question on that. Okay, how happy with your trading results? Okay. Are you happy with your 12-month performance? If you look back over the last 12 months, are you excited at what you see? And the answer, instead of just yes or no, the answers range from way yes to way no, and everything in between. We've got a wide spectrum here. And I predict that we're going to have about 20% in the first one or two categories, and we're going to have 80% in the last 3 or 4 categories. Let's leave it up there for a few more seconds and see how that chart fills out. Let's give it another 10 seconds from here. Thanks to everybody, ladies and gents, for casting your vote and for participating. We do appreciate that. And 1 minute. There's 1 minute. Let's close it. Let's go for the results. Hey, I was close. I said 2080, right? And it looks like we got 2872. The first 2 lines, 4% say, wow, absolutely, I am kicking butt and taking names. I'm very happy with my 12-month performance. And then 24% say, I'm doing all right. Making money, but not enough, all right? So, but at least they're making money. So in the top 2 responses there, 28%. That's a little high, actually. So we expect to see about 20% or less. 44% say mixed emotions, see potential but need to change your game. Well, guess what? You may have just come to the webinar that's going to help you do that. 24% say, ouch, I lost money last year. And 4% are ready to quit just to stop the hemorrhage. So listen, I'm going to make some bold promises to you, okay? The first bold promise I'm going to make is I'm going to show you the solution to a big problem facing buy and holders today. In fact, I'm willing to bet that you're going to take a look back and wish that you had thought of it sooner. We may run this poll again here, Mike, this are you happy with your 12 months performance poll? And say, hey, look, if you had done this, would you be happier with your 12 months performance? We may be running that poll later on. So I'm willing to bet that you're going to take a look back and wish that you had done it sooner. Number 2, I'm going to show you a riskless spread trade. Now, since we've got most of our audience that does trade, let me go back to that poll. I'd say most, but it's 50%, okay? 50% are already doing spread trades, okay? So here's a spread trade that's done into credit, and normally a credit spread involves risk, but remember I said this would be riskless. And this particular riskless spread can pay you twice, and that's what was promised in today's email. So I know that we've got a lot of real curious folks out there. Okay, number 3, I'm going to show you how it's possible to really take income from your stock without necessarily selling it or necessarily limiting the upside. So having said that, Mike, we're going to point out what the difference is, and I will give these strategies with no charge. Is that pretty cool?
I think that's pretty cool. Yes, sir.
Pretty cool. Okay, again, review. What they say is tell them what you're going to tell them, then tell them, and then tell them what you just told them. Okay, so so I'm following that format here. Here's what to expect there, guys. We're going to solve a big problem once and for all. We're going to share with you a riskless spread trade that captures premium but can't end up hurting you. And we're going to show you how to take credit without necessarily limiting your upside. So we've already done our baseline reading. How happy are you with your trading results? Let me ask you this, okay? If I could solve only one of these problems, okay, what do you think your biggest problem is? A genie in a bottle, and I could solve just one of these problems. What would you pick? What would you want it to be? Would you want to be better at picking stocks? Would you want to be better at timing trades? Would you just like to make a little bit more money when you're right on a trade? Or would you like to not get hurt too badly when you're wrong on a trade? Or are you, one of those 4% today that said, well, shoot, I'm doing very well, I'm kicking butt and taking names? Do you think there's nothing that anybody, including myself, could help you with? Okay. Let's leave that up there for a little bit. I see a clear winner already. Leave it up for another 5 seconds, and then we'll get jamming on that problem. Okay, 3, 2, 1, and close. Most popular result is 44%. I just want not to get hurt badly when I'm wrong. Okay. Second place is I stink at timing trades. Make me a profit. Well, guess what? I can't do that. I can't do that. Neither can anyone else. And most folks that claim that they can teach you how to know the future, most of those guys have something to sell you, don't they?
Absolutely.
Yeah. But Mike, let me ask you something. If I was to say, if I was to do a search on Google, and I'm looking for a system that will teach me how to time my trades, and I come across a system that claims to be right 44% of the time, do you think I'd be super impressed with that?
Well, no. How are you going to make money if you're only right 44% of the time?
Yeah. That wouldn't be a big endorsement for a system that is supposed to teach you how to be right. If you're right 44% of the time, it means you're wrong 56% of the time. You're wrong more often than you're right. Okay, but let's turn that around. What if it didn't matter? I mean, what if I said, how can I be right only 44% of the time and still make money? Would that be good? Well, now we're getting into that I just want not to get hurt badly when I'm wrong idea. Okay? Mike, I can help folks with that. I can help folks with that. Here's the problem. The problem is that most folks don't know when to sell their stock.
Right.
Most folks don't know when to sell their stock, okay? And here's a problem that sounds like not a big problem, but it is, okay? For example, what if your stock is up from where you bought it, okay? And that is a good problem to have, but now what? Now what? You don't want to feel like a chump by selling your stock and then seeing it continue to go up, and you also don't want to give back all your profits either. If for example you say, well, no, I'm going to hold on, and then the stock reverses, it comes back down, you might actually end up giving up all of your profits too. Okay, so here's the conundrum: if I sell my stock and it keeps going higher, I will miss the boat. On the other hand, but if I hold it, I might give back my profits. Stock goes down the drain. Okay, and those are haikus I couldn't resist. So why hasn't this problem been solved yet? So far, we've only discussed buying and selling and holding. Okay, but there is another option. Mike, everybody's heard this little chestnut: cut your losers short and let your winners run. Right?
Yes, it's a popular axiom on how to make money in the market, sir, and it does sound a lot like buy low, sell high.
Yeah, I mean, buy low, sell high is helpful until you are actually on the playing field. Right? It sounds like wonderful wisdom, okay, and then when you're actually trading, it's a relative term. Buy low, sell high. Well, did I buy low? I don't know. It seems to be heading down from here, so maybe I didn't buy low enough, right? Or sell high. Here it is. It's a little bit higher than where I bought it, but if I sell now, am I going to miss the boat? Okay, so the problem is few folks give the practical instruction of how to accomplish this. But what I'm going to talk about here, Mike, real fast is the exact opposite of cut your losers short and let your winners run. And why don't we talk about this for a moment? What are we looking at here?
Well, it looks like a profit and loss chart for a covered call position, which we know is very similar to the naked put profit and loss profile. And what we see here is some, I don't want to say propaganda, but we see some outlooks here. It is a bullish strategy, a neutral to bullish position, really. It shows that the risk is safer, and it shows that the reward is limited. Now, what do we agree or disagree with on these positions?
Well, I certainly agree that the reward is limited, because when you sell a covered call, right, you're agreeing with somebody else out there in cyberspace. You're agreeing that if the stock goes up, that you're going to deliver it, that you're going to be able to deliver at their price. That's what you're doing. And on the other hand, I don't agree with this risk being safer. And Mike, you've got a lot broader experience than I do, having counseled literally thousands of people over your 10-year career over at Power Options, and lots of them being covered call sellers. What has been your experience? Have they reported that the risk is very low?
Well, no, and even when they open the trade and they enter stop losses on the position, if they happen to be in a stock, as you mentioned, the gentleman that, I don't think this was the position he was in, but the gentleman that had the stock drop from 30 to 20 on him, that might have not happened overnight, but part of that large decline might have happened overnight. It might have dropped down to 23, and over the next 2 days dropped another 3 or 4 points on the position. But when you're using a covered call and you have a stop order, let's say put an 8% stop loss, Kurt, and the stock gaps down 25, 30, 35% overnight due to an early earnings warning announcement or just bad earnings altogether, I don't get filled at that 8% loss. I'm now holding a position that's down maybe 30% from where I bought it, and if I'm able to generate 2.5 or 3% in premium, if the stock stays the same, doesn't drop anymore, that's going to take me 10 months to get back to break even. And so what happens here is that these strategies, if you think about it, average return or an average premium, time value premium you can generate on a covered call, whether you're in the money, at the money, or out of the money, is about 3%. So when I buy a stock and sell a call and generate 3% premium, I'm still technically risking 97% of what I invested in the stock. That's a lot of risk, 97% risk to make a maybe 3% return. So that's that's one of the problems. But what we also look at here, the main complaint I've seen over the last 9 years, Kurt, is that over time, this covered call strategy ends up being a sorting machine in an investor's account, meaning that they pick winners. They might pick stocks that move up 6, 7, even 10% over a 30 or 45-day time period, but without putting more money in the position, they get caught with a 3% gain. So the winners are getting sorted out of their account. But then when the ones that lose are stuck in their account, and they're stuck trying to manage them for an 8 to 10 month period. And so then we end up at that time with a sorting machine where the winners are getting called away from us and the losers are staying with us.
Ouch. Yeah, and that's the biggest complaint that I've heard also, Mike, is that sorting machine analogy. And so this would definitely not be congruent with the idea of cut your losers short, let your winners run. In fact, it'd kind of be the opposite, wouldn't it?
Mm-hmm.
Yeah. Okay. All right. So spread trades. Now, Mike, let's say I'm right. Okay. Let's say we're going to do a bear call spread here, and I sell the 50s and buy the 55s. All right. Talking about calls. I sell a $50 call, buy a $55 call, and I'm right. The stock goes down $45 a share. Okay, I'm going to make money, right?
That's right. Mm-hmm.
All right. What if I was really, really right, and the stock went down to $1 a share? Do I make more?
No. You keep the same maximum profit, don't you, Kurt?
Right. Okay. And so the problem is, yeah, I'm actually cutting my losers short in the sense that I know what my initial risk is, right? I can't lose more than a certain amount. But I also can't make more than a certain amount, even if I'm right.
Mm-hmm.
And so that cuts losers short, but it does not allow winners to run. And that's the way most spread trades are. Most spread trades are set up this way. So, Mike, I got this crazy idea about 10 years ago. Well, actually, a little more than 10 years ago now. That maybe limiting my downside and leaving the upside open was a better way to go. And so far, I haven't been proven wrong. You know, the first stock that I got into this way was Amazon. And I got into Amazon 100 shares at $16.09, and I also bought a $20 put option. And what happened, Mike, if I had sold, for example, with Amazon at 16.09, I guess the call that I would sell would be like the 1750s, right?
That's right. Uh-huh.
Yeah. If I had sold the 1750s, I would have felt like a chump, because over the next 13 months, and the period of my put option was longer than 13 months, but over the next 13 months, Amazon increased by nearly 300%. Boy, I would have felt silly if I'd have settled for like a little 6% gain, you know, for in 1 month for a covered call. And so limiting your downside and leaving your upside open, that sounds a lot more like cut your losers short, let your winners run, doesn't it?
Absolutely. We're forced into that position, aren't we?
Yeah, it's a structure in which it's kind of an artificial discipline. You know, we force ourselves into a corner and make ourselves do this. It's like having a workout buddy. You know, I mean, you could if you were going to try and lose weight or tone up or get fit or whatever by your lonesome. Well, you know, one day when you feel a little sore or a little lethargic, you might not get started. But you know, if you have a workout buddy and you've got a commitment to that person and they've got a commitment to you, and you've got to reach a certain goal together, well, you know, that's different. Okay, and the same thing. This is kind of a forced discipline. You're actually, you know, by buying that put option, you're putting yourself in the company of a powerful ally that will keep you out of trouble. But won't limit your growth potential. So here's how to structure an RPM, a radioactive profit machine. Okay, and Tuesday, we showed how to structure one from the beginning. But a number of weeks ago, I asked subscribers for situations where they had a stock that they were in and it was up. Okay? And so for today's presentation, what I'm going to do is I'm going to share Carol's situation. Okay, Carol has shares of Visa at a cost basis of $84.60, and at the time we put this together, I think it was about 2-3 weeks ago, those shares were trading at $120 and change.
Right.
Mike, where are they now?
Visa?
Uh-huh.
Let's see here. I just had that open in front of me. Here we go. Sorry, Kurt. Visa today is at $120.48, $120.48.
Okay, so this may or may not be a good setup. Let's find out. Okay, so Carol's got shares of Visa. And what that means is she's got a gain to protect of $35.40, right? She got the Visa shares at 84.60. She's got a $35.40 gain to protect. Okay, how about this? What if we take the Visa shares and purchase a September 2012 $125 put option for $10.40? Okay, well, the total invested then is $95, but she's guaranteed to be able to get out of that at $125, right?
That's right. The put option guarantees an exit of $125.
Okay, all right. So the total amount at risk then is a negative $30. I mean, her investment so far is $95. She's guaranteed to get out at $125. So she's guaranteed all the way up until September to have a profit here of $30. Now, some folks will look at this $10.40 and say, wow, you're throwing $10.40 away. Well, not necessarily. You see, the stock was at 120, so at least $5 of this is intrinsic value, right?
Right.
Right. She's locking herself in at a profit. See, what we've got here is we've got the familiar hockey stick graph of a married put, but what's unique about this particular married put?
Well, because she had a gain to begin with, and she bought the put after the fact in this case, there's no break even. There's no loss possible on the position. It's sort of heads you win, tails you don't lose.
Yeah, exactly. If the stock falls below 120, she's going to be happy that she had that $125 put. Okay. And if the stock goes up, well, there's no limit to her upside. Okay. Gosh, even the $5. Okay. I know that a lot of folks have some alarms going off in their head. Wait a minute. Who says I want to spend $10.40? To protect my stock? Well, okay, fair enough. But how about we do something to finance the cost of the put option? How about we do something to grab some premium? Okay, so first off, the cost isn't really $10.40. Some of that's guaranteed to come back, right?
No, absolutely. We had some intrinsic value on that position.
Yeah, some of it's guaranteed to come back. The stock was at 120, and it's a $125 put option, so $5 of that 1040 is intrinsic value. Now you know, Mike, because because this is one of your specialties, rolling the put. You know that if the stock goes up, you don't necessarily lose on that put. You're going to be able to roll it and actually lock in a higher return. Okay, but $5 of this 1040 is something we can't lose. So that remains $5.40. $5.40 is all that you're really risking in the first place. And now I want to show something completely different. There's my little tribute to Monty Python. All right, now for something completely different. Check this out, Mike. What is this graph here describing? We talked about it in the...
yeah, this looks like a ratio call spread. We have a peaked maximum profit on the position. There's a concern there where it appears we have unlimited risk on the upside.
Right. As the stock goes up, this is the direction of the stock moving up. As the stock moves up, you could have unlimited risk, and that's not good. Okay. The ratio call spread, the way that I show it, is put together at a credit, so it pays you on the front end. And if the stock stays below its present cost, that's what this green line is. If the stock stays below its present cost, you're going to have a credit. If the stock goes up from its present price, you might actually get a second credit. You might get paid twice, and that's what we talked about in the email today. Okay, and then of course here the purple line is a break even. If for example stock continues to go up, we may end up breaking even or even getting into trouble. Now, I've got an idea. Okay, I've got an idea. Why don't we do this in the context of already owning the stock? If you already own the stock, then any risk that's what do I say, that's posed, any risk that's posed by having short calls, that goes away, right?
That's right, Kurt.
Right. You can't get hurt. This is from selling 2 calls and buying 1. Okay, so if you sell 2 calls, $225 calls for $3, and buy a July $120 call for $5.50. That's what the prices were that day when I put this presentation together several weeks ago. Well, that gives you a credit of 50 cents, right? That's this front end. And if the stock goes up to, say, 125, what happens at 125 on expiration Fridays?
Well, the 2 calls expire worthless.
Right.
The 120 call now has $5 worth of intrinsic value.
Right. So it's going to be worth more. You know, it could actually pay you twice. On the other hand, we're not doing this naked. If we did this naked, we'd end up with naked calls. But because we're doing this in the context of owning the stock, well, we don't put anything at risk. See, the objection is, well, doesn't that put even more at risk? That 50-cent credit comes with infinite liability. Well, no, it doesn't. Not if you own the stock.
Right.
That's why I suggest the ratio call spread, doing it within the context of owning stock at a lower cost basis. If you do, you can't get hurt. Kind of cool, right? It's a riskless spread trade now. It's a riskless spread trade. It's a spread trade that pays you to begin, may pay you a second time, and can't hurt you. Okay? So when you have the stock on hand delivered, there's no risk to your capital for doing the ratio call spread. In fact, Mike, this is what Carol's new position looks like. Kind of looks like the Loch Ness monster to me, you know. Again, she's bulletproof, right? But rather than the hockey stick graph, we've got this accelerated point of growth between 120 and 125. The stock ends up between 120 and 125, but Carol's going to get paid again for doing her ratio call spread.
That's right.
That's pretty cool. Okay, so one thing that a lot of folks don't get is that you can often close a ratio call spread early. And Mike, let's maybe look at it. Let's look at it right now. Visa's at 120.48, you said, right?
That's right, Kurt.
Okay, and we took a 50-cent credit for selling the $125 calls and using the premium from that to buy the 120 calls. Okay, so right now, can you tell me right now what the $120 call is bidding at?
These are July's?
Yeah, July.
$1.72.
$1.72 is the bid for the $120 call. Okay, and what are the $125 calls asking at?
It looks like 25 cents.
25 cents. Okay, now check my math on that.
Oh, I'm sorry. I'm sorry, Kurt. My apologies. I'm looking at the chain. I'm looking at the new weekly series that expires in 8 days. My sincerest apologies. The bid for the 120 is $3. This is pretty easy.
Oh, it's $3. Oh,
yeah,
okay.
The bid for the 120 is $3, and the ask for the 125 is $1 for the standard July expiration. My fault.
Okay, so correct me if I'm wrong, but let's see here. If we were to buy to close the
two 125s, that'd be $2 or $200, right?
Okay, $2, right? And if I sell to close the
120s,
120s, then I get what?
$3.
$3. So is that a net of $1?
Yeah, you could liquidate it right now for $1 premium.
Isn't that cool? You see, we put this thing together for a credit of 50 cents, and we could liquidate it right now for a credit of $1. Very cool, huh? All right. So you can often close a ratio call spread at a credit too. That would be $1.50 captured, and the stock has just moved sideways.
Right.
The stock has only moved sideways. We've gotten paid twice, and by the way, the that put option is protecting us from disaster. okay?
Mm-hmm.
And here's why. It's because if the underlying goes down or travels sideways, the short calls lose value much more quickly than the long call does. So that makes for some awesome management opportunities. Okay?
Okay. One
Let's say
question.
that we...
Oh,
Go ahead.
one question, Kurt. I wanted you to address this based on the profit and loss chart. There's two answers. Well, there's two comments you probably want to make on this. Paul wants to know, with that income method number 5, didn't we just limit your upside? And we were talking about letting the winners run and cutting our losers short. But did we just, sort of cap our upside with that income method number 5 trade?
Yes and no. Okay, here's the yes part. The yes part is that 100 shares are obligated by one of the short calls, and the short call is obligated by another short call.
Mm-hmm.
Okay, so if the stock goes up for a period of time, we're going to enjoy double returns, right? As our covered call
Mm-hmm.
gets called away and our bull call spread closes in the money, okay? But that's the near term. See, the thing is, we've sold a July ratio call spread, but the put option that we own is far out in time, right?
That's right, Kurt. Absolutely.
Okay, so there's one or two things that can happen. One is that that we hold this money net play until expiration,
Mm-hmm.
and then manage it. And another is that we do only half the number of ratio call spreads
Right.
that we have shares of stock. So if that's done, if we do half the number of ratio call spreads to the number of shares of stock that we have, we leave our upside unlimited also. Okay, so two different ways that upside can be unlimited. One is July expiration happens and we close in the money. Then we still have unlimited upside in our married put. And the other is if we take a smaller bite,
Mm-hmm.
then we'll still have unlimited upside. Okay. All right. So say that we do hold the money net play until expiration. We got paid to put it on. You have the stock on hand, so there's no risk for adding the ratio call spread, right? And
Yes.
then you would get paid again at 120. You get paid at 122. You get paid at 123, all the way up to $129.99. So anywhere between 120 and a penny and 129.99, you're getting paid a second time. That's about a $10, nearly a $10 spread
Mm-hmm.
that stock can land up in. Okay, anywhere in here, and you get paid a second time. Kind of cool. Ta-da!
Mm-hmm.
So that's what I think is really cool about adding a ratio call spread to a married put position, where you can't get hurt, but you can get paid twice. Okay, and then of course that $5.40 that we invested in the time value of the put, that's going to come down by however much we capture with our money net play.
Right.
All right, so if Carol's stock goes down, she'll be happy that she picked up the put, right?
Absolutely. She locked in that profit on the position due to the price of the put and the gain she already had. Yes.
Yeah, and she put $10.40 into it, but $5 of it's guaranteed to come back. So
Mm-hmm.
so $5.40 is really all she had put into it. And at this point today, she will have paid for $1.50 of it if she were to close the bear call spread. I'm sorry, the ratio call spread.
Mm-hmm.
If she were to close it, she will have paid for most of that that time value going into that put, and there's still time value left. Okay, if if the stock goes down, it's a good thing, right?
Yes.
If it goes sideways, it's a good thing because the ratio call spread will pay her a second time. That's what we are looking at today. And if it goes up, well, the money net will capture as much premium as she spent on the put option. Okay.
Right. The difference in the strike prices, of course, and then the initial net credit. That's right.
Right. So here's the point. The income methods are going to reduce the gap, and if we reduce the gap to less than 0, we're going to be bulletproof and also be paid to do it.
Mm-hmm.
and that's kind of cool. Okay, that's a thing that Carol just may be looking at if indeed she got into this position. Okay, so what had been the problem? The problem was that she had an $84.60 cost basis, and the present price is at 120. She had no guarantees of what would happen next. What's possible is that you can build a fence around the stock with options. The only way that she could lose by doing a married put is if the stock just travels sideways, right?
That's right. Mm-hmm.
Yeah, because if the stock goes up, well, okay, she's making money. and that benefits her choice to hang on to the stock. If the stock goes down, it's like, well, I'm glad I bought the put.
Right.
Okay, but sideways, then the time value is running out. Well, that's countered by the fact that the ratio call spread does best when the stock is traveling kind of sideways.
Mm-hmm.
Okay, so what's possible for Carol is to build a fence around the stock with options so that she can grab 50 cents now, maybe more later, and those are done in the near term while the put is protecting her long term. And that's kind of cool. See, what's different now is that she can cash in that stock at $125 no matter what happens to the downside. Okay, and she can play those ratio call spreads in July and August and September.
Mm-hmm.
You know, that put option is protecting her clear out to, oh shoot, I forget what it was. Is it August or?
The calls were July, right?
Yeah, let's go back. I want to see. I want to remember what we had done for Carol here.
Nope, you just had it. It was the September put. Norman got us. Norman was paying attention. You got the
Yay,
September
thanks,
put.
Norman. All right, yeah. I feel kind of silly there. Okay, so the September put, you know, can be paid for by way of these near-term plays.
Mm-hmm.
And the worst thing that could happen, well, the worst thing that could happen is that the stock goes down. Well, if the stock goes down, we're glad that we had the put option in place, and we paid for a portion of it. And the other thing that could happen is if the stock goes up. Well, if it goes up, there's a possibility she can capture extra for what she's done. The money net will capture as much premium as she spent on the put option, so it ends up that she has a net zero cost on that put option. And there's management opportunities too. We can roll the short one of the short calls and perhaps pick up even more premium and not have to deliver.
Mm-hmm.
So kind of cool. All right, so there we are, reducing the gap to less than zero equals bulletproof. So what had been the problem? She didn't have any guarantees. What's possible? Well, by using options to build a fence around it, we make it so that if that stock goes up or down, she's still going to do better.
Right.
So she can play those ratio call spreads in July and August and September and do okay. Before, the stock was unprotected and stagnant. Now the stock has a nice warm overcoat and an intriguing possibility. We might even capture more than we spent to protect it. That's kind of an exciting possibility.
Mm-hmm.
So here's Carol's position now. Can't get hurt, but she may be able to do even better than if she had just been sitting on the stock.
Right.
Okay, so do we have questions?
Oh yeah, we had a few come in, and we answered most of them. One thing that we wanted to talk about, Kurt, is the. Well, sorry, Jan just put in a comment. Wouldn't it be smart to do this with every stock you buy? Well, not necessarily. Is it smart to open it as a married put position as a radioactive trading technique? I agree. That's why 50 to 60% of my trading account in the last 4 years has been involved in these positions. But it's not necessarily always a great idea to try to force this income method number 5. Remember, there's 10 different income methods that we use. And addressing one of the questions that came in earlier, of those 10 different income methods, some of them work best when the stock has moved up in price. Once I've bought the stock and bought the put, Jan, I might wait for the stock to move up 5% or so and look to apply one of those bullish income methods. But I have a few income methods I can apply if the stock stagnates after I first open the stock in the put. And if the stock falls, there are income methods that I can use. I had a conversation Mary asked earlier, Kurt, she said, well, when I made the comment about the 50 to 60% of my trading capital, she said, well, if you're trading, risking 6% of your positions or 6% of 60% of your capital, if the market falls, well, you're down 6% or more of your entire portfolio. No, there's two levels of protection first that go along with the married put. When I invest in a position, I've got 6%, let's say 5 to 7%, maybe 4 to 7.5%, Kurt. That's where the risks I shoot for. 4 to 7.5% of my invested capital in that position is at risk. But we use another layer of protection where every married put I open, or we open, I should say, Kurt, the monetary risk only represents 1 or 1.5% of our total portfolio value. That's part of one of the three core principles of radioactive trading, forces us into an ideal size trade. But we also mentioned, I also told Mary that, in those situations when the stock falls, of course, is that there are methods that you can use. It doesn't always work out this way, but Kurt, in 2008, remember, I had the Office Max trade, one of the first RPMs I opened, bought the stock at 20, bought a 22.5 put. 5.5 months later, the stock was down 75% of its value. It was trading at about $5 per share. I closed the RPM at that time, but I had been applying the income methods following the rules in the blueprint, and I was actually able to close it for a 1.6% gain. Now, a lot of people are going to say, oh, well, that's not letting your winners run. You only had a 1.6% gain over a 5-month period. That's nothing.
Beats
it's better than taking it. Yeah, that's right.
That's right. Chart of a 75% loss, and the thing is, when you've got capital to buy at the bottom, that's exciting. You were able to ride that stock down, get out with a small profit, and still have some capital left over to continue to invest. Whereas other people that were in the Office Max position lost 3/4 of what they had.
That's right.
Even if Office Max doubled from where it was, they still would be behind. Not cool. Yep. Mike, I put a couple of polls up there. Let me go ahead and close the most recent one. What do you think is the most important part of today's lesson? And bulletproofing was the number one thing. And then 31%, second place, was limiting risk down to single digits, was something way better than a stop order or cover calls.
Absolutely.
Yeah, pretty cool. I also ran this poll. I said, if every spread you did was heads I win, tails I win more, would you like that? 89% said you're darn tootin'. And 11%, I think you're mostly joking, but 11% did say, nah, I like risk to be higher than reward. It keeps me young. Well, actually, the thing is, Mike, we've got more than just this spread trade being riskless. We've got more than just this particular setup. But at Radioactive Trading, that's what we're concentrating on delivering you, is spread trades that could become riskless.
That's right.
And that's what's really important. It's not so much making money, but not losing.
Absolutely.
Yeah. Okay. Let's see. I guess that's it, unless we have a couple of more questions. And if I might jump into another mini presentation, because I've got several minis set up to use the rest of our 5 minutes here, 5 or 6 minutes. But folks, if you have questions, go ahead and hit me with them. Hit Mike with them.
Yeah, Mary also had commented that, earlier she was talking about she prefers not to buy stock. Would this technique really help her? And, well, the core principles of radioactive trading, forcing an ideal size trade, proper risk management, they apply to any strategy, really. But you've shown over the years, Kurt, and in the blueprint you do talk about this, but you've shown over the years how the lie of leverage, whether you're protected or whether you're insured, or, we have the customers who all say, well, the long call is the same thing as that married put setup, and it's really not. The long call done a certain way could be considered a parity trade, but most investors don't apply that. The nature of the investor is to overtrade, to put more of their money into different positions, and so it's never truly a parity trade at that point.
Right. What Mike is talking about is, hey, isn't a long call the same as a married put? Well, no, it's not. It's not. A married put and a long call are similar, but not the same trade. And there's different rules regarding them that just beyond the laws of mathematics, there's also the rules of, for example, your IRA or your broker may not allow you to sell calls against calls or do ratio call spreads against calls, but they will allow you to do something like this against a stock. For example, you might own 200 shares of stock, and then you might buy a call and sell 2 calls. So what have you got? You've got a long call, which your level 1 trading clearance allows you, and you've got 2 cover calls, which your level 1 trading clearance also allows you. And then you can also do an IRA. Well, hey, how about that? What you've done is a ratio call spread, a 1-by-2 ratio call spread, but you've done it in such a way that it's within the rules. Okay, and so that's one of many benefits of trading a married put instead of simply buying calls. Okay, other questions?
Yeah, well, Paul and I were having this discussion, and I had you address that about, how the upside is capped. We talked more about, okay, well, if you've got 400 shares of stock in an RPM and 4 puts, and let's say you sell 4 calls, Kurt, and you buy 2, well, in that case, the upside is still unlimited. You still have 200 shares of stock that have an unlimited upside profit potential, right? And he says, well, yeah, but you've cut the winner short on, you've cut it short on 200 of those shares. Well, that's true, but this is a choice, okay? And what I mean by that is that, Kurt, you're very successful with income method number 5. You've used that in your account very successfully over the last several years. Ernie's very successful with income method number 1. It's not something that I use that often in my radioactive trades because income method number 1 can cap your gain, but Ernie's very successful using income method number 1, as are you. I tend to gravitate more towards income method number 4 and income method number 6, simply because just the way that I trade and what I'm looking to accomplish. So there are different ways that you can apply it. It's your temperament. That's exactly right, Paul.
Yeah. The arsenal that you have with having 10 different income methods gives you some choices. It gives you some flexibility and opportunity. But what happens is I'll see folks get into the same stock, right, at the same price point, and then do different things with it. It's going to depend on what that investor's goals are, what their tolerance for risk is, and also what they kind of like. You like to do income method number 4. And, the fellow that set up my my MIT lecture, he also almost exclusively does income method number 4.
That's right. I forgot about that. That's right, Kurt.
Yep. So, well, super. Well, we got about a minute and a half, and I wanted to close at the top of the hour. I want to thank everybody for coming.
I'm sorry, Kurt. One more quick question.
Let's allow it.
All right. Roman asks, looking at the Visa example, selling 2 July calls and buying 1 July call does not produce a net income. Is this correct? No.
Today it doesn't.
Right. Today it doesn't. That's right, Roman. Today it doesn't. It did when Kurt initially was helping Carol with that evaluation.
Yeah. And the day that I did that was the day that I made this this presentation. I made this presentation probably 3-4 weeks ago. And so on that day, it was possible to generate a 50-cent credit. Now it's possible to generate a dollar credit by closing it.
Right.
By closing it. So
in this case, that's a perfect example, sort of.
Yeah.
It's a perfect example.
Yeah.
If we were in that Visa trade now and we analyzed an income method number 5 and we saw we couldn't do it at a credit following the rules in the blueprint or what we were looking to accomplish, well, I could still look over and say, oh, but here's a good income method number 6. Here's an income method number 4 I might be able to use now, or here's an income method number 1.
Where are the September $125 put options now?
Good question. Sorry, I just let me go back here. One page. All right. Our September 120 puts, Kurt, we are trading at a bid of 610, ask of 620.
Bid of 610, ask of 620. Okay. All right. So so essentially, Carol still would have protection. She would still have protection, and the $1.50 that she could realize by closing the income method number 5 today would pay for some of her losses on the time value.
Mm-hmm. That's right.
I would actually, if I were Carol, I would actually just continue to hold.
Well, here's the interest.
Everything.
Yeah, here's that interesting aspect. Let's review this very quickly, Kurt.
Uh-huh.
You showed buying that put for $10.40, right?
Correct.
And at the time, the stock was where?
I think it was right at 120.
Oh, okay. So, but that was the 125 put you bought, right?
Yes.
Okay. Let me look at it this way. So you bought the 125 put option, which had $10.40 total cost, which came out to, I'm sorry, the math is not working with me today. It was $5.60 of intrinsic value? Wait.
$5 of intrinsic value.
5 even, okay. Okay, $5 of intrinsic value. So right now, it's just looking, the bid price on that one is $8.70 for the 125. So
it's $8.70, okay.
The 125, you asked me about the 120, because I thought you were looking at a rolling down and in or something with an income method number 3. I apologize, but you asked about the 120. The 125 is at $8.70. Yep.
Yeah, $8.70, okay. So it had been at $10.40.
Mm-hmm.
So it has lost $1.70 in value, right?
Right.
Which value is about the same as what you could close your ratio call spread for?
Mm-hmm.
Close the ratio call spread for an extra $1 today. But I wouldn't do that if it were me. If Carol, if you're listening, this is what I would do. I'm not making a recommendation, but I'll tell you what I would do. I would hold on a little bit longer to this ratio call spread and see if I can't close it for greater than $1 credit.
Right.
Yeah. So essentially, yeah, she's at a 20-cent debit. She's paid 20 cents so far to protect her price point at $120 or $125. Pretty dang cool.
Someone had mentioned, you mentioned a free resource, Kurt, and I think I missed it. Joe had asked, what was the free resource you mentioned earlier? Oh, it's up there, powerup.com/RAT, Joe. My apologies. There it is.
Yeah, I wanted to make it available to folks to check out power options without any obligation and without supplying your credit card number or anything like that. Just try out power options. That's what I use to keep the time down in selecting stocks to play, and also in computing what it's going to look like when I do an income method.
Right.
Yeah, it's all the graphs that you saw today, for example, are out of the Power Options suite of tools.
Mm-hmm.
So pretty cool. Okay. Well, Mike, thanks for coming there, sir. Let's see. Today is Thursday. I'm looking forward to seeing you on Tuesday. And I wonder.
I'm going to leave that up to you, Kurt. What you want to do on Tuesday?
Was that July 4?
No, it's July 3rd, and the market closes at 1 p.m. on July 3rd. Some people may be going on vacation early, and we are closed Wednesday, July 4th, of course. So if we wanted to do a presentation right before the holidays, that's entirely up to you, sir.
Okay. I think we may just stick with July 5th. We'll,
all right, Thursday, July 5th. We'll get that posted for us. So our next presentation will be Thursday, July 5th, folks.
Happy. All right. Well, Mike, thanks for coming, and thanks everybody for staying an extra 4 minutes. We'll see you out there, and as always, if you think of a question after the presentation, I know how irritating that is. We'll shoot. Just send us a line at support@radioactivetrading.com, and we'll endeavor to get that question answered for you right away. Okay?
Absolutely.
Sending that link to you. Okay, Mike, thanks for coming, and thanks everybody. We'll see you out there. Happy trading.
All right. Take care, everyone. Happy trading.